behind it most likely, but you guys are on top of it. So I really appreciate this and everything that you do for us. Thank you. So hello, everyone. We will talk today about how to take advantage of the tax benefits that were released by the government because of Corona-19 or coronavirus. We also have, I'll share some other information unrelated to COVID-19, but this is an opportunity to ask questions and get some information around the CARES Act tax relief that was put out by the federal government a few months ago. And if you have not taken action with regards to some of those items, that you start doing that as soon as you can if you qualify or if you think it's beneficial for your company. So Kelsey and the team organized this event today. It's called Rebuilding Your Company Runway Post-COVID-19 Using Tax Benefits. And before we go on to that, I would like to speak to you about myself and my company for a little bit. I joined right in March, right before COVID-19, and I haven't had the opportunity to meet all of you in person, but I'm looking forward to meet everyone over the next few months when we go back, or next year. If you're not going back this year, hopefully we can go back sooner. I am a CPA and certified financial planner, and I founded my company, Fibric Financial Services, about 5 years ago. And the way we work with our clients, tech startups, most of them, is that we're very focused on what your needs are, very personable, very responsive. And the idea is to help you navigate all operational accounting issues, but also cash flow planning, going through an exit transaction or a merger, just anything that you need on the accounting and finance side. We would like to be your partners to get that done. And in addition to owning my accounting firm, I love doing workshops and training. So if anyone needs any training, happy to help, or any feedback on anything that you guys are putting out there. These are some of our clients. We have worked with Abacus, Yext, Radar Labs, if some of these names are well known in the startup world. And we're very excited to work with founders and their team to help them navigate tax and accounting and finance issues. And the agenda for today is we will first talk about the PPP loan. I will give you an overview of the loan and the requirements, and I'll tell you a little bit about the tax implications of getting this loan and getting it forgiven. I'll talk to you about the payroll tax credits that were made available through the CARES Act, some income tax reliefs, and also I would like to remind you of some of the basics, all the tax benefits and deductions that startups should be taking advantage of regardless of COVID or not. So let's start with the PPP loan, the Payroll Protection Program loan. I hope a lot of you qualified for it. This is an amazing opportunity to get a loan from the federal government and get it forgiven, so you don't have to pay a single penny of this, and actually fund your payroll for a couple of months and some other expenses. The way the PPP was structured was that you would get, as a company, 2.5 times your monthly payroll for 2019. That was the way you calculate this loan. If you didn't have payroll, if you were the only owner and you were treating yourself as a contractor or self-employed, you still qualified. So the deadline now is June 30th of this year. If you have not applied, let's do that as soon as we finish this webinar and take advantage of the benefits. The loan, if used, 60% for payroll and 40% for rent, mortgage, interest, or utilities, all business related. Let's clarify. If you use it in that manner within 24 months, you can get 100% of it forgiven. You don't have to pay it back. That sounds awesome. So let's run and get that loan as soon as possible. I know that a lot of business owners were struggling with the application, or do I qualify? I don't have payroll. My lender is not responding. All of that can be solved through going by going through SBS, the Small Business Services Agency of the City of New York. They will give you assistance to apply for this loan. You can also reach out to multiple lenders. You're not stuck with just your bank. So you can go online, and I'm sure some of you have these relationships with fintech lenders or might be fintech lenders. And I know that several of them were approved to issue this loan. So you can apply with many. The first one to submit the application to the SBA, the Small Business Administration Agency, that will be the first lender that will continue with your application. The expenses that you use towards the forgiveness of the loan, the payroll costs that you incur within 24 months that amount to the total that you're going to be forgiven, and the same with the rent. And by the rent, we can pay the rise rent in a few months too with those funds. Mortgage interest, if you have a mortgage for the company, utilities, which includes your phone, all those expenses that you use towards forgiveness are not tax deductible once you use it towards the forgiveness, but also the amount of the loan that's forgiven is not taxable. So there is a wash at the tax in the P&L in terms of the tax return between the loan amount that's forgiven and the expenses that you use towards forgiveness. Those two offset each other, so there is no tax impact of that on your tax return for 2020 or 2021 if you split the usage of the funds over the 2 years. One thing that's interesting with this loan is that let's say you got $50,000 of that loan, and you don't know if it's going to get forgiven or not, right? We don't know yet. We're going to submit the expenses, and most likely it will be. However, because there is a big probability of this being forgiven, you can start actually accruing a portion of the forgivable amount in your income tax, in your profit and loss statement, which will help your EBITDA, your operating profits look better, right? So normally we wouldn't have this loan to cover our payroll. Our payroll costs will be $10,000 a month, and that would take away from our net profit or increase our net loss. But because now we're gonna get a little bit of an offset to that, you can start accruing that now and actually reduce your loss or increase your profit by showing this accrual. Once you apply for the loan and it gets forgiven, there is some accounting that needs to be done there to make sure that everything is reflected in the right place on the P&L, profit and loss, or the balance sheet. So that's the overview for the PPP. Let me just add a little bit on the application process. There will be an application process, an application that you need to submit at the end of the usage of the funds to apply for forgiveness. The application is out there online for you to start getting familiarized with it. There is a lot of information that needs to be calculated, the payroll costs for the year, and the number of employees that you had before versus now. Because one of the big things about this loan is that you must retain your staff, right? So the basis of this loan is that it's supposed to help us retain our teams. You're not penalized if someone leaves on their own, or you have to let someone go because they're not performing well or because of conduct. And also, if you let someone go during COVID, you have the opportunity to rehire them in order to have this loan forgiven. But if they don't want to come back and you have evidence that they don't want the job again, that is not going to go against the amount that is going to be forgiven. I'll make a pause there. Kelsey, do we have any questions?
I don't see any questions in the chat. If anybody has questions, you can feel free to shout them out at this time.
Yes, I forgot to mention that. Thank you, Kelsey. So we can, at the end of each slide, I will pause for a little bit so you can ask questions about that specific topic. But at the end of the presentation, we can go back to more questions. Great. Yes, was that you, or does anyone have a question? Was that you, Kelsey?
Yeah, I think I was just muting myself. You're good.
Great. So now let's talk about the payroll tax credits. These credits were actually were also part of the CARES Act from March. And the idea here, again, as you can see, most of the benefits of the CARES Act was focused initially on retaining employees. So the PPP loan was to retain the staff. The payroll tax credits was to reward you for retaining your staff if you experience, as most business owners did, if you experience a decrease in revenue or profit. So the first credit that we have here is the employee retention tax credit. And this credit is being given to business owners who kept their teams, all their staff members throughout COVID, and also experienced a decrease in revenue of 50% or more. And there is a quarter that you can compare. It's not for the full year. If you had in Q1 of 2019 versus most likely it would be Q2, but let's say it happened in March. But Q2 of 2019 versus Q2 of 2020, if you have a decrease of 50% or more in revenue and retain your staff, you can get a credit of up to $10,000 per employee. And this is actually being tracked now by your payroll providers. So if you're using a company like Gusto or JustWorks, you can actually apply for this credit through them. And it's an easy process, and based on the salaries and of your staff that they have records of, this credit would be automatically applied to your future payroll taxes due. And there is also an opportunity to request a refund if the credit that you're receiving is less than the taxes that you owe for the quarter. The second credit was a refundable tax credit of up to 100% of wages paid for paid sick leave or paid family leave due to COVID. So if you had an employee that needed to stay home because they were sick or because they had to take care of a child and their daycare wasn't open or school wasn't open, you can get a credit towards payroll taxes for wages paid to that employee. And the last one here is a deferral of of employer payroll taxes. So what this is your portion of the payroll taxes, Social Security and Medicare taxes, any taxes that you owe between March of 2020 through December 2020, you can defer it and pay it in two payments, 50% at the end of this year, 2020, and 50% at the end of 2021. So this is a way to manage your cash flow. You still have to pay that, but you can use the funds now for something else. And payroll taxes, as you might know, on the employer side, they can be significant depending on the number of employees that you have. It's about 7 and 8% of just the Social Security and Medicare. So if you have a large team, this will make a difference in your monthly cash flow, and let's take advantage of it. If you know that this you need the staff, you need the cash now, keep it, use it, and then in 6 months and then later in 12 months, you will have recovered, hopefully, and use then the future funds to pay the taxes that you have accumulated during this next 6 months. Again, with this, you should apply. If you want to take advantage of this, you should notify your payroll provider, and all online. If you're using one of the major ones that I mentioned before, Gusto, JustWorks, TriNet, ADP, they all have all this set up within their platforms, and there is not special documentation required. It's kind of just click a button or a box and check a box, and this is going to start automatically being deferred. I'll pause for a second, just in case there are any questions. Kelsey? No? Good. Okay, great. All right. So we covered so far. I covered the PPP loan and the payroll tax release or credits and deferrals. Now let's talk a little bit about income taxes. So income taxes is going to be, our income taxes are based on your net profits. And if you were at a loss in prior years, which might be the situation of some startups, if you're at a loss in prior years, you would have accumulated a net operating loss over the last few years. If you had a year where you're profitable, let's say in 2017 you were profitable, then 2018 you had a loss. In 2018, there was a change to the tax rules that said if you had a loss in 2018, you cannot go back and apply it to a prior year. You have to go forward and apply that operating loss to future profits. I'm going to assume that this is something that I should explain just in case. So a net operating loss means that I lost money this year. I made 100,000 in revenue, 200,000 in expenses, have a loss of 100,000. If that happens today, I keep $100,000 of a loss kind of in my pocket. And next year, if I have $100,000 of profits, the two will offset. There is a small, they cap it at 80% of your profits. So you can use 80,000 of this year's loss to offset next year's profits, let's say. What happened during COVID now is that the IRS is saying you can now take the loss from 2019, let's say, and instead of having it to carry it forward to the future, you can go back and apply it to a prior year when you had a profit. And what that will do is that you will go back and amend that prior year return, use your loss, reduce your profit, and get a tax refund. So that's the great benefit of this change, and it's due to COVID. It's temporary, but if you did have a large profit in 2017, for example, you had a loss in 2019, you can now go back and amend 2017, apply that loss, and get money back. So that's the first point there. The other, some of the other income tax reliefs included an extension to file your 2019 income tax returns and to pay the related taxes to July 15 of this year. You can still apply for an extension to file through the through the 15th of October if you're a C Corp, and if you're a pass-through entity, LLC, or partnership, you have until September 15th. But with the extensions, which are always there, you still have to pay by July 15th. So you have to estimate a tax liability, pay by July 15th, and then file the return by September or October. This relief here was really to defer the tax payments from April through July, which was very helpful to a lot of businesses because they didn't know what to expect in July and May, and maybe even not today, but this helped a little bit, at least not to have to stress out over filing a return by April 15th and having to pay a liability by April 15th. The third bullet that I have here applies more to pass-through entities, LLCs and S-Corps and single member LLCs, partnerships. And what this is, in the past, prior to COVID, there was a limitation on the losses that you could offset against non-company income. And there is a limitation. It's pretty significant, but it can make a difference to a lot of some taxpayers. That has been adjusted. And I don't have all the details here because it's a little more complex than just a couple of lines. But if this is something that might impact any of you, we can, you can talk to your tax accountant and figure out if you are affected by that. The other change that happened was on the fourth bullet point. It was a modification of credit for prior year minimum tax liability, and this is referred to the AMT. There is an adjustment now where you can potentially use some of the AMT credit in this year. This is not typical of most companies, most startups, but it was worth mentioning just in case someone has been affected by this in the past. And the last bullet here is modifications of the limitations on business interest. Believe it or not, the there are limits in the amount of interest expense that you can deduct as a business, and it's based on the revenue. It could be based on different factors, but there is a modification to this now in 2019 for the 2019 tax return, and hopefully for 2020, where if it is worth looking into if you fall under one of this any of these categories where this might impact your business. I'll pause for a second just in case there are any questions. And you can wave. You can just go like this. Thank you, Kelsey.
Yeah, no questions in the chat so far, Ramona.
Yeah, so taxes are either something that we all know, which is good, or something that we all hate and we don't even want to bother talking about. So hopefully this is just this is giving an overview so that you can go back to do a little more research. You can go back to your accountant. You can find an accountant and figure out if any of this impact you and how you can take advantage of this for 2019 and 2020, so that you can take the benefits of it, can increase your cash flow or your operating expenses, operating profit, or increase profits or reduce losses. So the next item I have here, which is what we talked about before, were changes related to due to COVID, and there were a few major components there. We took PPP loan, and then by the way, when the CARES Act came out in March, there were two loans. There was a PPP, which is the one for retention of employees, but also there was the EIDL, which is an emergency injury disaster loan, and that one had been closed. They reopened that one, so look into that too. That just happened this week, I believe, and I didn't have it on the slides, but go back to the CARES Act loans through the SBA and see if you qualify for the second one, if you are interested. But in addition to talking about what happened because of COVID, I wanted to bring you back to the regular, let's not forget that these ones are all there, and remind you that as a tech startup, you don't have to be a startup, you can be a large firm, and you might qualify for this. We should take advantage of these other deductions and credits that sometimes small businesses, because they're busy, they don't have the time to pay attention to this, they might neglect. So for example, the R&D credit is a credit that's available to companies that are creating or enhancing an existing process, technology, or in the case of manufacturing companies, it can be related to manufacturing. And the way it works is that for every dollar that you spend in research and development, that's the R&D part, for every dollar you spend, you get a 10% credit potentially. And it's a huge tax benefit if you have the right, if you're tracking your costs that way. So if you have an engineering team, they'll qualify, their costs will qualify for the calculation of this credit. If you use consultants, it's all based in the U.S. So if you are doing if you're developing your software here in the U.S. with consultants based in the U.S., those costs would qualify for the calculation of this credit. And this credit, if you are profitable, it offsets profits, so taxes on profits. If you're not profitable, this credit can be used to offset payroll taxes, which is great for cash flow. A lot of the startups that are not profitable yet use this tax credit to reduce their payroll tax liabilities while they become profitable. And you have as many years. There is no cap. As long as you continue to enhance your software, your technology, your processes, you might qualify. You go through a process to calculate this, to support the credit. There is a company that there are companies that specialize in this process, and then just put something nice together to use in your income tax return to claim the credit, and then your payroll tax company gets a nice form and they apply the credit to the payroll tax if that's the route that you're going. So do not neglect this. I hear a lot of times founders of the startups that say, I don't have the time to focus on that right now. But you do a little bit of you make a little bit of an investment at the beginning with a company that puts this together for you. And the first year might be a little rough and might take a little more time, but the next few years, because they have been working with you, the time investment is going to be less. And the reason it takes a little bit of time is that they have to talk to you to understand what is it that's being enhanced, what is it that's being created, why could it be, why would it qualify for the R&D credit? And they have to go through that interview process, but also put together a calculation, may have follow-up, they'll ask for payroll data and cost data. So it takes a little bit of time, but it's worth the investment of time. The second bullet here is deductions for business use of personal property. And this is your home. If you work from home, you can have your company reimburse you for the cost that you are allocating to business use. If you are not a C Corp, then you can actually have that deduction go through your personal tax return instead of having the company reimburse you. But this is something that a lot of times business owners forget and they just don't take advantage of it. If you're using your phone for business, your home, your car, just make sure that you are tracking that and that you actually get that as a deduction for the business, but it's reimbursed to you. Now, the thing to remember here is that if you have employees, the right thing to do is to have the same policy for all the employees. So if you're eligible as an owner to get reimbursed for the personal use, for the business use of your personal phone, it is expected that you do the same for your staff members. So look into whether you can do it for one and not the others without breaking any laws or any tax laws, but also other laws that I'm not covering today. The third item here is the deduction for vested restricted stock awards and non-qualified stock options. We see a lot that business owners a lot of times have all these issue options to their advisors. This is not qualified stock options to employees, more to advisors, consultants. Generally, those options are non-qualified. They're treated differently than the ones for employees. And because they are different, they are, once they vest, the company will actually get a deduction in their tax returns. And this doesn't happen all the time because there is no cash exchange. There is really not a reminder of this as telling you, okay, we have to go back to the income statement and book a deduction for this RSAs and options that vested. So just putting it out there so you start thinking about that if you're not doing it already. The next bullet here is capitalizing costs versus for financial reporting versus expensing for taxes. The reason I wanted to bring this up is that you have, in some cases, you have the option to accelerate the expensing of an asset for tax purposes, even if you want to allocate it over a longer period for book purposes. So I'll explain that. Let's say you buy a machinery, a computer. Let's pretend that a computer is super expensive. Buy a computer that costs $10,000. You don't want your income statement to look bad by putting $10,000 in month one as an expense. But there are rules in the IRS code that would allow you to expense in full that $10,000 in the tax return, and you can still allocate the $10,000 for books purposes in your internal financials. You can still allocate it over, let's say, 5 years if that's the life of the asset. So keeping track of that, you have to do a little bit of accounting and make sure that it's not double deducted in the tax returns. If your books are clean and organized, you can do this without causing a lot of headache. But what I don't like to see is when we okay, we're spreading this 10,000 for 5 years, so we only get a little bit of a deduction every year, when I could have taken a full deduction in year one for tax purposes. And of course, sometimes it makes sense and sometimes it doesn't. If you already have a loss, you don't need an additional deduction. Maybe you want to spread it, but if you have a huge profit this year, you want to deduct as much as you can so that your taxes are less. The last two items are accruing expenses. All the expenses that you have incurred, regardless whether you have paid it or not, need to go in your books if you are on an accrual basis. And accrual is when you recognize the expenses or the revenue, even if cash hasn't exchanged hands. And cash basis is when you recognize the revenue or the expenses only when cash exchange takes place. So if you are on an accrual basis, you want to dump all your expenses in the year that they were incurred, even if you haven't paid them. So all these expenses from 2020 that we might end up paying in 2021, expenses from 2019 that we didn't pay in 2019, let's put them where they belong so that you don't miss out on the deductions that these cost. Because otherwise, if let's say you had expenses in 2019 that you forgot to accrue, you might get away with taking the deduction in 2020, but that's not the right thing to do. We're supposed to take the deductions in the year that they took place. So by not accruing them, you might miss out. If you try to deduct them in the wrong year and you're subject to an audit, they might be denied as a deduction for that year, and you have to go back and amend, and it's just more of a headache. And the last one, I wanted to bring this up because retirement and other benefits for employees, of course, we all know they're an expense, right? But it's also a good way to invest in our talent. I always encourage our clients to invest in things that would add value long term. And of course, as a tech company, you are going to invest in your technology. You're going to, of course, that's the first thing. The next thing is talent. Investing in our employees through salaries, the benefits, retirement plans is always beneficial, I find, for retention and for attraction of talent. And when you think about these benefits that you're giving to the employee, the net cost is what you're paying minus the taxes that you are saving by that incurring that expense. So I always think about it that way. If it's costing me $1,000 to provide a 401k for a staff member, and I get to deduct that at the business level, and my tax rate is 25%, it's really only costing me $750. So that is always something to take into account when you're thinking of taxes. That's not always the first thought in our heads, like how is this helping me from a tax perspective? But if you do consider that along with all the other benefits and the vision for the company long term, you might be able to make a decision easier or faster than if you don't consider the tax benefits also. So those were my slides. I welcome your questions, and now or later you can reach out. I'm on LinkedIn. You can send me messages through LinkedIn, Instagram, everywhere. Hopefully we can also, I'm on Slack also, so we can discuss anything there. If any questions come up after today, please reach out. And if I have an easy answer, if it's in my head, I'll respond. If it's not something that I know or requires calculations, I will let you know too.
Great.
Thank you, Kelsey.
Thank you so much, Ramona, for your time. I recorded this so we can share it with our community as well, as I mentioned to you. And thank you for allowing people to also reach out to you if they have questions.
No, thank you, Kelsey. This is, I appreciate you organizing this. And yes, please share, and anyone can reach out anytime. Thank you.
Thank you, Ramona. Have a great day, everyone else.
You too.